The largest financial explosive device on the planet may have already begun its countdown, and this time, the danger is not originating from China. The pressure point is Japan, America's closest strategic ally. For 4 decades, Tokyo has acted as Washington's financial lifeline, accumulating more than $11,000 in United States government debt, a larger position than any foreign country in the world. But now the yen is collapsing into a historic spiral, and the Bank of Japan has moved toward what traders on Wall Street describe as the nuclear option. To stop its own economy from unraveling, Japan is being pushed into unloading United States Treasury bonds at an unprecedented rate. Every bond sale sends another tremor through American interest rates, while the dollar edges closer to a liquidity crisis. Fresh custody figures released by the Federal Reserve revealed the warning sign clearly. Foreign official holdings of treasuries declined by $8.7 billion during the week, ending May 6, 2026. The timing was impossible to ignore. During that exact same period, Japan deployed $54.7 billion purchasing yen in an emergency effort to stop its currency from smashing through the symbolic 160 yen per dollar threshold. The mechanism behind the crisis is brutally straightforward. If Tokyo wants to support the yen, it must acquire massive quantities of its own currency. To do that, authorities need dollars, and the fastest way to obtain those dollars is by liquidating America's most tradable financial asset, United States Treasury bonds. In practical terms, the nation financing America's debt has now started selling the very instruments connected to mortgage costs, lending rates, and the broader stability of the United States economy. To understand why Japan has entered this trap, the scale of the currency collapse must be fully understood. Since December 2020, the yen has lost approximately 54% of its value against the dollar. This is not a normal currency fluctuation. It is one of the most severe, prolonged depreciations ever experienced by a major developed nation in the modern era. 5 years ago, $1 exchanged for 103 yen. Today, that same dollar purchases roughly 159 yen. Inside Japan, the consequences have been devastating for ordinary households. The country depends heavily on imported energy, food, and industrial products. As the yen weakens, every shipment arriving from abroad becomes more expensive. Daily living costs continue climbing higher, while the government faces a fiscal prison with no painless exit. Japan's national debt has swollen to roughly 227% of gross domestic product, the highest debt burden among major economies worldwide. The Bank of Japan now owns more than half of all Japanese government bonds in existence. In almost any other developed market, such a concentration would be unimaginable. Yet Tokyo relied on this strategy because private investors alone could never absorb the enormous flow of government borrowing, while yields remained close to zero. The central bank effectively became the permanent buyer of nearly everything. But the support structure is beginning to crack. Through the opening months of 2026, the Bank of Japan started reducing its monthly purchases of Japanese government bonds from nearly 400 billion yen to around 200 billion yen beginning in April 2026. The purpose was clear: allow the bond market to regain some normal market function. Instead, yields exploded upward once the central bank loosened its grip. Japan's 10-year government bond yield surged to 2.537%. The highest level seen in almost 30 years. The 30-year Japanese government bond yield tells an even more alarming story. Just 5 years ago, it stood near 0.65%. Now it is approaching 3.6%. One market analyst warned that if this trajectory continues, those long-term yields could move toward 5% within a single year, placing them near the same territory as United States 30-year Treasury yields. This is where the real nightmare emerges. Analysts describe higher Japanese yields as a poisoned chalice. If the government suppresses yields and keeps rates artificially low, international currency markets punish the country with a rapidly weakening yen. But if yields are allowed to rise naturally, the financing cost of Japan's enormous debt pile becomes catastrophic. Official projections already estimate government interest payments reaching 41.3 trillion yen by fiscal year 2029. That figure alone would consume around 30% of Japan's entire national budget. Nearly 1/3 of all tax revenue collected by the state would disappear simply paying interest on old borrowing before funding schools, hospitals, transportation systems, or military programs. The Bank of Japan is cornered. Raising rates aggressively to defend the yen risks detonating a sovereign debt spiral. Maintaining ultra-low rates accelerates the currency collapse. Expanding money printing to buy even more bonds only adds inflationary pressure at a moment when over 83% of consumers already expect prices to continue rising during the next year. There's no painless escape route remaining. The only uncertainty is which wall Japan collides with first. And that reality explains why financial analysts increasingly view Treasury liquidation as Tokyo's final emergency lever. By selling United States government bonds, Japan gains the dollars required to enter currency markets and purchase yen directly in an effort to stabilize the collapse before confidence disappears completely. Japan's Ministry of Finance did not accumulate those treasury holdings by accident. They were built for moments exactly like this. Finance Minister Katsunobu Kato openly confirmed that the country's $1.225 trillion position in United States debt exists primarily to guarantee enough dollar liquidity whenever intervention in the yen market becomes necessary. The so-called nuclear response was never hypothetical. It was always sitting in reserve. The only unknown was the exact point where survival became more important than restraint. That threshold has now been crossed. Then came the Iran conflict. Brent crude surged past $113 per barrel, climbing more than 50% from the moment the war erupted. For Japan, the impact was devastating because the nation imports almost all of its energy supply. Oil priced at $130 in dollar markets effectively feels closer to $130 to $140 once converted into yen because the currency itself has collapsed at the same time. The pressure is now multiplying everywhere at once. Import costs for energy are spiraling upward. Japan's current account position is weakening rapidly. The yen has already fallen to 160 against the dollar, and every defensive measure available to the Bank of Japan creates another crisis somewhere else in the system. Jens Nordvig from Exante Data described the contradiction with brutal precision. Trying to defend the currency without adjusting domestic monetary policy, he warned, resembles lightly pressing the brakes while your foot remains fully planted on the accelerator. Maybe the passengers enjoy the thrill for a moment. Eventually, the brake system burns out. On April 30th, Japan spent $54.7 billion purchasing yen in an attempt to halt the slide. For a brief moment, the currency stabilized. Then, within only 3 trading sessions, the downward pressure returned once again. The underlying force driving the collapse never disappeared. The United States and Japan remain separated by roughly 300 basis points in interest rates, creating a powerful incentive every single day for investors to dump yen and hold dollars instead. Currency intervention cannot erase that mathematical reality. Now, 3 separate pressures are converging simultaneously, all pushing Japan toward larger treasury liquidation. The first force is direct currency defense. Every intervention campaign requires enormous dollar reserves. The second comes from rising domestic Japanese government bond yields. As returns inside Japan become more attractive, institutional investors are beginning to move capital back home instead of parking it in American debt markets. The third pressure may be the most dangerous because it removes choice entirely. One analyst stated it bluntly. Regulatory capital rules themselves could eventually compel Japanese institutions to sell regardless of what they personally prefer to hold. Japan still controls approximately $1.225 trillion in American bonds. Yet, in only 1 week, authorities already confirmed $8.7 billion in treasury selling, and none of the 3 forces driving those sales higher are fading away. The implications for the United States are enormous. Mortgage costs, savings account returns, the massive carry trade sitting underneath global financial markets. Every one of these channels eventually reaches ordinary American households in direct dollar terms. A major Canadian bank released one of the clearest institutional analyses in March 2026, though almost nobody in the public paid attention. Their economists reached a deeply unsettling conclusion. Even if Japan reduces treasury purchases slowly and in an orderly manner, without panic and without weaponizing its holdings, the impact could still push the United States 10-year treasury yield higher by roughly 20 to 50 basis points over the medium term. That may sound small to the average person. In reality, it is massive. Every basis point matters in a debt-driven economy. Mortgage rates follow the 10-year yield. Corporate borrowing costs move with it. Even the federal government's own interest burden on $3,900 in national debt is directly linked to those benchmark rates. An increase of 20 to 50 basis points is not statistical noise. It represents a permanent structural rise in borrowing expenses spreading across the entire American financial system. The mechanics behind this shift are well documented and brutally logical. For decades, Japan's near-zero interest rate environment pushed enormous quantities of Japanese savings overseas, searching for higher returns. The Government Pension Investment Fund, the largest pension fund on Earth, with approximately $187 trillion in assets, directed vast amounts into United States treasuries. Life insurers followed. Regional banks did the same. Trust funds joined them. The calculation was identical across the system. 0 returns domestically, around 4% abroad. That flow transformed Japan into the single most stable long-term buyer of American government debt in the world. Their steady demand helped suppress United States borrowing costs below levels that pure fiscal fundamentals would normally have produced. But that era is now fading. Japan's 10-year government bond yield has climbed to roughly 2.3%. Meanwhile, once cross-currency swap expenses are included, a fully hedged United States Treasury position delivers only about 1.3% in yen-denominated returns. For the first time in decades, Japanese domestic bonds are generating stronger returns than hedged American debt for institutional investors inside Japan. The direction of rational capital allocation has completely reversed, not because of politics, not because of military conflict, because the arithmetic itself changed. Official figures, released by Japan's Ministry of Finance, have already revealed the trend. Since the opening of 2026, net foreign security sales reached roughly $25,000, with the retreat accelerating sharply in recent months. Even government-linked institutions, once considered the steadiest overseas buyers of United States Treasury debt, have begun pulling back. These are not speculative hedge funds chasing short-term trades. These are sovereign-connected financial giants, repositioning portfolios built over multiple decades. For years, the yen carry trade constructed what analysts described as a $1.22 trillion river of artificial liquidity flowing through global markets. Investors borrowed yen at almost zero interest rates, then redirected that money into higher-yielding American assets: treasury bonds, technology equities, private credit, commercial real estate. As long as Japan maintained ultra-low rates and the yen remained weak, the strategy generated enormous profits almost automatically. That hidden stream of liquidity quietly pushed United States asset prices far above levels domestic fundamentals alone could justify. Now the equation has reversed. The Bank of Japan's benchmark policy rate has climbed to 0.75%, the highest level recorded since 1995. Japanese 10-year government bond yields have surged into a range between 2.5 and 3.7%, levels not seen in roughly 3 decades. Meanwhile, the interest rate gap separating Japan from the United States has narrowed substantially from its previous extremes. At the same time, hedging expenses have become far more costly. Brent crude, rising beyond $130 per barrel, combined with the energy shock created by the Iran conflict, introduced a new layer of volatility that fundamentally changed the risk profile of carry trades. One economic research group explained the danger directly. In this environment, carry trades become severely asymmetric. Small negative market movements can erase months of accumulated gains almost instantly. Instead of patiently holding positions to maturity, investors rush to unwind leverage the moment instability appears. The warning already arrived once before. In August 2024, the Bank of Japan implemented a rate increase of only 0.15%. That single move triggered a violent yen rally. The Nikkei collapsed 12.4% in one trading session, marking its worst performance since the Black Monday crash of 1987. Shockwaves spread across global markets immediately. The S&P 500 plunged 8% within 3 trading days. The VIX Volatility Index exploded to 65, levels associated with pandemic-era fear. In only 72 hours, approximately $2.5 trillion in worldwide market capitalization disappeared, and conditions today are even more dangerous than they were during that August collapse. Since that earlier crisis, Japanese government bond yields have climbed by almost 100 additional basis points across the entire curve. Pressure on leveraged carry trade positions has intensified rather than eased. Every future Bank of Japan rate hike now being anticipated by markets ahead of the June or July meetings tightens the financial trap even further. And American stock markets, sitting inside millions of retirement accounts and index funds across the United States, remain heavily exposed to exactly the sectors most vulnerable to carry trade unwinding: large-cap United States technology firms, NASDAQ growth companies, long-duration financial assets. These are the areas that suffer first when global leverage begins reversing direction. Now comes the critical distinction that must be understood clearly. Japan is not preparing to dump $11,000 of United States treasuries into markets within a week. Tokyo is not attempting to weaponize its bond holdings against Washington. Finance Minister Katsunobu Kato explicitly rejected any such intention. A rapid liquidation campaign would destroy Japan alongside the United States. Massive selling would collapse the market value of Tokyo's remaining treasury reserves, trigger a violent depreciation in the yen that would cripple Japanese exporters, and ignite a bilateral financial crisis, damaging both economies simultaneously. The logic of mutual destruction remains a powerful restraint against the most extreme outcomes. But there is another force nobody can stop. The underlying structural pressures moving Japanese capital away from American debt and back toward domestic bonds are economic forces, not political decisions. Higher yields inside Japan, rising currency hedging expenses, energy import shocks, funding requirements for yen intervention, regulatory capital rules. These are matters of portfolio mathematics. And mathematics does not negotiate during diplomatic meetings. The United States government must issue approximately $11,000 US dollars in debt during 2026. Around $2,000 will finance new deficits, while another $9,000 must refinance existing obligations rolling over in the market. Every single basis point of Japanese demand that disappears from treasury markets must eventually be replaced by another buyer. And those replacement buyers demand higher yields as compensation. That reality is already visible. Even after multiple Federal Reserve rate cuts, the 10-year Treasury yield remains above 4.4%. Markets are already pricing in the structural shift caused by Japan's monetary normalization. The so-called nuclear option is not arriving as one dramatic detonation. It is unfolding slowly, automatically, through thousands of portfolio rebalancing decisions made by Japanese institutional investors following the oldest rule in finance. Capital moves toward the best risk-adjusted return available, and for the first time in an entire generation, that destination is increasingly becoming Japan instead of the United States. If you want to keep tracking every Bank of Japan decision, every Treasury custody report, and every new yen intervention as this financial story intensifies, stay connected and keep following the developments closely. The consequences reaching household savings, mortgage rates, retirement funds, and global markets are no longer distant theories. They are already unfolding in real time. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.